Okay, let's jump right in because we need to talk about a number that just sent some serious shockwaves through the US economy. I'm talking about the jobs report for February 2026. It's a big deal, and it's pointing to a slowdown that's got a lot of people worried. So, in this explainer, we're going to break down what happened, why it's happening, and the incredibly tough choices that are now on the table. And this is the number that has everyone talking. Negative 92,000. Yeah, you heard that right. It's a pretty jarring figure to see, especially after we've gotten so used to years of steady job growth. So here's the thing. This isn't just an abstract number. It actually represents a major contraction in the job market. After the numbers for January were recalculated and already showed things were cooling off, this report pretty much confirms it. The trend is real. The US job market is officially hitting the brakes.
But what do these big economic numbers actually mean for people on the ground, for you and me? Let's go a little deeper, beyond that one headline number, to really see the human cost of this slowdown. Well, one of the most immediate consequences of losing that many jobs is that the unemployment rate goes up. It's now jumped to 4.4%. And what that means is simple. More Americans are out there actively looking for work, and they just can't find it. And you might be thinking, well, maybe it was just a bad month, right? But this isn't some random blip on the radar. It's becoming a pattern. The U.S. has actually lost jobs in 3 of the last 6 months. That shows a clear, persistent softening in the labor market. So where are these jobs disappearing from? Hospitality took the biggest hit, shutting 27,000 jobs. But the real head-scratcher here, the one that's really surprising, is healthcare, down over 18,000 jobs. This is a sector that's normally a super reliable engine for growth, but now it's actually contributing to the losses, in part because of striking workers. And of course, we're seeing big cuts in manufacturing, construction, and even the federal government. And for anyone who's actually out there looking for a job, things are getting tougher and taking longer. The average time it takes to find a new position has now stretched out to almost 25 weeks. Just think about that for a second. That's nearly 6 months of stress and uncertainty for the average person trying to find work. This incredibly long search for work has pushed a huge number of people into a really tough spot. We're now at a point where 1.9 million Americans are considered long-term unemployed. And just so we're all on the same page, long-term unemployment isn't just a casual phrase. It's an official government designation for someone who's been out of a job for 27 weeks or more. The fact that almost 2 million people now fit that description, well, it really highlights how severe this situation is becoming. Okay, so if people are out there looking for jobs, why aren't companies hiring? To get that answer, we kind of have to switch our perspective and look at what's going on from the C-suite, from the executive level, where some major uncertainties are causing them to hit pause. It really boils down to 2 big forces. First, you've got corporations kind of stuck in this state of limbo. There's so much uncertainty around tariffs and inflation that it's just really risky to take on new payroll expenses. And then there's the AI effect. You have companies literally pausing hiring because they're waiting to see how much work can be automated before they commit to bringing on new people. And all of this leads us to the biggest question of all. What can we do about it? Right now, all eyes are on the Federal Reserve, which is facing a truly high-stakes dilemma. And believe me, there are no easy answers here. The core question is pretty simple, right? How do you get companies to start hiring again? The most powerful tool in the toolbox is to cut interest rates. But actually using that tool right now is, well, it's really complicated. And here's the massive curveball. Just when you think things couldn't get more complex, a new conflict with Iran is threatening to shut down key shipping channels. And if that happens, it's almost certain to drive up the cost of energy and other goods. This outside pressure puts the Federal Reserve in an unbelievably tight spot. This lays out the tightrope the Fed has to walk perfectly. On one hand, they could cut interest rates. That makes it cheaper to borrow money, which should, in theory, get companies to expand and hire. The huge risk, though, it could pour gasoline on the fire of inflation right as global events are already pushing prices up. On the other hand, they could hold rates steady to try and fight that inflation. But the price for that stability could be an even weaker job market and more pain for people looking for work. So we're left with this absolutely critical question. As conflicts overseas threaten to make everything from gas to groceries more expensive, can the Federal Reserve figure out a way to boost the job market without causing runaway inflation? It's a question with no easy answer, and the livelihoods of millions of people are hanging in the balance.